Hello ladies and gentlemen. As usual, we start the week's review with the fixed income market in the States, and as you can see, we've moved all of about 1 basis point on the week in the 10-year. The market is completely dead. As we keep on saying every week, we are stuck between 275 and 3 for the whole of the summer. As time passes, we are becoming more and more convinced that at some stage we will test 275. It's just a question of time. But as this 200-day moving average comes up, it'll be time to buy basically put spreads in the market. As you can see this even better on this futures chart. We are approaching just above. If we get to above 121, 121 and a half ish, it'll be time to buy 121 and a half to 119 and a half put spreads, and ride the wave back down. That is just about all that can be said for the 10-year in the States, and the 30-year in the States. Very much the same kind of picture. As we said last week, this is TLT. If we ever get 124 to 125, it is really time to start getting in some put spreads. We really think it's going to be very hard, even on a on bad news in the States, to push through 125. So 124 to 125 is a great area to buy puts in TLT. This situation is slightly different in Europe. Europe is still riding the lower Bollinger Band, and looks like in the 5 years we could get to somewhere around minus 38 to even minus 42. Minus 38 to minus 42 over the course of the next 2 or 3 weeks is going to be a wonderful place to start getting short of the bobble. And this matches with the Bund. This is kind of the level that we would be hoping for, around 16, 17, 18 basis points. That would be that would match with maybe the 10-year at 275, and that would be a great level to, especially around 15, 16 basis points, to get some put spreads in the bunds. It's even clearer really in the BTP. This is the level, the middle Bollinger Band on the weeklies, where this gap is, and that is around the 221, 222 area. That is going to be a wonderful place to get short of BTPs. That I think is somewhere around 132, 20, 30 in the futures. So quite a long way to go before you get there, but if you see it over the course of the next few weeks, it's going to be a great place to get short. The S&P 500 last week did exactly as we expected. It got to 2,800, and we are now going to more or less ride the moving average here and the top of the Bollinger Band. It is the summer. We don't have, apart from earnings, we don't have too much else. Earnings are already expected to be stellar, so it's tough to see the market breaking through this 28-30 region of the Bollinger Bands, and really even with the earnings, it would be very, very difficult to see the market breaking this moving average, which is going to be around 27.20 next week, or even should be caught by these, which are around the 27.60 area. So really between a 27.60 and a 28.30 trading range for the next few weeks is what we would expect. The most overbought market, the one which we think has probably needs a pause that refreshes, is actually NQ. Around the 7,500 area is going to be a wonderful place to unload all longs and basically reload, probably somewhere around 7,100. The market really is unsustainable in terms of it will be a two-way trade between 7,500 and 7,100. It is very, very unlikely that we just keep on going higher unless we have some huge surprises out of earnings. But since the expectations are so high already, that is very, very difficult to see. And this is all our friend, the Dow against the Qs. As you can see, it keeps on riding this lower line, and that is why we think it's very unlikely that technology can actually lead very much at this stage. It is more likely to retrace and let the Dow do some of the work, in which case the market isn't going to go very far on the upside in the S&Ps. As you know, the S&Ps can only really go very far on the upside when technology leads, like it did last week, rather this week. It is unlikely that that is going to be repeated over the course of the next couple of weeks. Therefore, 28.30 in the S&Ps seems to be a very reasonable level to lighten up and definitely even go slightly short for a move back into the 2700s. Another spread chart which says there should be a bit of caution with tech at the moment is the SOX, the semiconductor index against the yen. This move here has been nearly all yen as opposed to semiconductors, which tells us that we are getting tired. We couldn't make a new high. We're getting tired in semiconductors, and if semiconductors cannot push, the rest of technology is unlikely to be able to push the indices very much higher by itself. In which case a two-way trade is called for the next couple of weeks for sure. Let semiconductors breathe a bit and then maybe they can go again. SPY TLT, which this is, and I will now enlarge it, it is actually looking quite tired. It's just, even with a big move last week, it hasn't really made that much of an impact on it. It's still way above the highs, and therefore it is signaling two-way trade, say between 230 and 240. This to us indicates a range-bound market in both bonds and equities. It is unlikely that we, since we're already up close to 2% this month in the equities, it is unlikely that we're going to have much more on the upside. So 28.30 as a level to cut out is very sensible. The dollar to us actually is a bit of a puzzle. We expected slightly more strength. We haven't got it. We seem to be completely stuck between 95.07 and 93.63. That seems to be the trading range. We cannot close above 95.07, and therefore we are not going to get any help either way in deducing important trends from the dollar. It looks very much stuck in this trading range. We would go with a break either side. We prefer a break higher and the test of 96.50 at the very least, but we're quite happy to go with a break of 93.63 on the downside. We don't expect it to happen. We think sideways trading down to the lower Bollinger Band is more likely. That is around just below 94. But should it break and close the week below 93.63, we would have thought that something important is going on and would be looking for the next leg down, which would certainly be around the 92.50 area. That is going to be very, very important. We haven't changed these numbers for, well, forever, and they are here for you to watch and look at all the time. An important chart for you to watch is XLF. XLF really needs to break needs to break quite a bit higher. It needs to break above this high of 27.40 and go into the 200 period moving average around 27.70, or even higher, 2780. It needs to do it to support any kind of up move in ES. If that does not happen, ES is going to languish, certainly with pronounced bouts below 2800. For it to stay above 2800, really XLF needs to now help, because XLK is getting tired and needs a rest. An important chart to look at is actually the Wilshire 5000. The Wilshire 5000 has broken higher and cleared this very important level at 29,146. That to us is the reason why we still think that the S&Ps can get to 2830 over the next few days before we have some sort of a late July swoon, and then the pause that refreshes basically, and then we can go higher. That is why we don't think this is going to be very easy to achieve. We certainly think that the market should trade around 29,428 and potentially go into the gap at 29,500. But it is getting tired. This has been a lot of work, and we need a few days of consolidation and of testing of this line from above, and then we can possibly go
However,
again.
this is by no means a bearish chart. To us, it's likely that we will at some stage even exceed these highs, but it might have to wait for the end of the summer and the beginning of the good seasonality around October. So it certainly is not bearish. It is not something that the markets are not something that we're worried about. You saw last week how the market couldn't even fill the gap that it left, and that to us was very, very significant. If you can't even fill the closing gap on bad news like tariffs, you're likely to ratchet up more than you're likely to collapse. These moving averages have all turned upwards, and they're going to offer very, very good support on the downside. That's why we think around 2760 is going to be very, very good support that the market is unlikely to break. The New York composite is slightly less bullish, but still a chart which inspires some confidence that it will break this 12,853 level at some stage and trade higher, certainly somewhere into the 13,070 area. That is the most that one can expect it to do this month. We certainly would be good sized sellers up there, because we think it's more likely that we need to retest these levels around 12,620, and that actually is more or less 2760 in the S&Ps. Volatility this week has taken a bit of a dump, and really you are likely, when the market breaks this 2800 to 2815 area, to get a further washout down towards 1370. But at 1370, and this is the VXQ18, which is will be the front month very soon, is going to be a wonderful level to buy some calls for it. At some stage we will get a move, certainly back to somewhere around 16. So it's it's a no-brainer. You buy some long-term calls and you just lock them away. 1370 is such good risk reward that certainly we will be doing it. So the biases don't really change very much. It might take all summer, we said, in the 5-year and 10-year note and in the 30-year note, and that's exactly what's happening. I have now put here the levels for you in the Bobble, the Bund and the BTP, so you can be sure what our levels are, where we want to get short of those markets. The XBX 2830, we can't see it with the dollar this strong unless the dollar collapses. 2830 we think is going to cap it. The elevated tail risk is still present.
That is why we are happy to remain long of out of the money calls and out of the money puts. Only below 2700, as you know, is bad. That is why we think 2760 catches it on the downside for at least the next couple of weeks. NQ did outperform on the upside. We now can't see it any higher than 7500-ish for the exact reason that we told you. The market needs a rest. XLK and the Qs and NQ have done an awful lot of heavy lifting, and unless the SOX helps them, this is about as much as they can do. We are quite happy to basically exit our oversized longs at these levels and wait for pullbacks. Now you have to watch XLF, because unless that helps, then really ES can't really outperform. 2780 is the level, and this is what we said last week. Look for 27 at least. We've got the 27, but now we need to push through 2780 to make ES any higher than 2830. While XLF is below 2780, we are unlikely to break 2830 in the SPX. And here is the level in volatility, 1370, very important level at which we will be buying VXQ18 calls. That is the dollar range, 95.03, 93.63. Go with the break, but we certainly favor an upside break eventually, and we would be surprised by a downside break, but we will go with it either way. Thank you very much indeed, and tweet you on Monday.